Hey guys, Mike here. So obviously it's going to be a huge week this week in the stock market with all the big mega cap stocks reporting. And if you hadn't noticed by the thumbnail, they have gotten off easy compared to all the other tech stocks out there. They have held up. The institutions have not been attacking them or selling them off. Except, if you hadn't noticed over the last 3 days, what's been happening? They've been coming under fire, even with Tesla reporting fantastic earnings, good guidance. They end up selling off, while a company like Snap, just to show you how crazy the market is, misses earnings. The guidance was not that good at all, and they end up almost, I think it was 5% Friday, when the whole market was just basically a bloodbath, as some of the members described, and everything was selling off, right? And so, but you had Chinese stocks up and Snap. That was in Twitter. Don't forget Twitter. I mean, that's the kind of market we're in right now. But, there's a couple things going on. One, nobody's talking about. So I found an interview on this one because nobody's talking about this. It's the first time I've heard anything about this and how it affects the market. And the other one is just, listen to a fund manager tell the truth. What's happening? What's his clients, trying to buy and get into? And, he has nothing to gain or lose by saying what he says, but it's always good to hear from him to see what's happening. So if you're getting out of it, hit the like, subscribe button, notifications all, really appreciate it. And let's go ahead and just get into what we're looking at this week and what is going on in the market right now that people need to be aware of. And to start off with, these numbers come from January 1 to the date, right, of what's happening in the market. And you can see right there, Apple. For some reason, that stock is untouched. It's the biggest out there. And it's down less than the S&P. It's down half as much as the NASDAQ as a whole. You see Amazon, Alphabet, Microsoft. Put Tesla in there. It's only down 18.5% as well. I mean, the only two really mega caps has been destroyed are Netflix and Facebook. And when you compare that to other tech stocks, I don't care what sector they work in, I put all different ones up here. You see Taiwan Semiconductors for the year down 26%, Uber's down 30%. Anything to do with biotech is down 30% or more. Nvidia's a big one, down 36%. Palantir is down 36%. Square is 38%. Pinterest is down 46%. Coin 47%. Snow 48%. DraftKings 50%. PayPal's been crushed at 56%. And that's just from January 1 of this year. If I go back to November, you're talking about 60 to 90% down for those stocks. Okay, that's how bad it's been. But that's just comparing apples to apples with that one chart. Okay, and so you can see it's been hands off, right? That's why you hadn't seen the S&P sell off and actually crash down 20%. That's the real reason for that, right? Because they account for so much of the index. Now all of a sudden, there's a chance they do come under fire, right? This is a big week. So the question is, what are people doing? When I say people, I mean like people with a lot of money doing right now, and where are they going to, and what are they not touching?
I think the biggest read-through for tech right now is that it's a buyer strike. It's chilly out there. I was in Boston and New York seeing clients all week, and no one wants to touch tech. Our desk is very quiet on the tech side. Everyone's concerned about the fundamentals. And are we going to see a drop-off as it relates to the fundamental demand? Valuation has reset. That is the number one debate. That debate is gone now. The number one debate is, are fundamentals going to hold? And I think investors right now do not want to be in front of this next week. I think most CFOs are going to talk more cautiously about the macro economy. And if they don't, our clients aren't going to buy these stocks because it's inevitable that everything is starting to slow. There's companies like Snap, right? Good growth. They de-risk and they said, hey, look, we're not expecting growth to stay high. It's gonna decline. And so the companies that actually give in and take the hall pass, you have to take the hall pass right now. You have to guide more conservatively. If you don't, those stocks are going to get hit harder because no investor is going to buy it. Our clients are going to buy the names that hit the reset button on the expectation. And I think there's a handful of names that we're getting closer. But right now, no one wants to be in tech.
And so it seems like that's going to be the new norm, right? I mean, Snap kind of proved that. Missed their numbers completely. Plummeted in after hours, gave their guidance and saying, it's not going to be as good as it was in 2021 or 2020. But we're going to keep working. We still have growth. And the people said, all right, we like the honesty. Appreciate it. And they bought the stock up and it went up 20%, from down 15 to up 5%, while other stocks sold off. And so that's what's going to be interesting to hear this week is I have no doubt a lot of those companies are going to hit the guidance hit the numbers, but it's all about that guidance, right? Because there's no way those numbers, those growth numbers, can be as good as they were in 2020 and 2021. There's just no way around it, okay? And so that's going to be interesting to see what they say. It's going to be interesting to see how institutions, do they say, okay, still makes the valuation attractive or not? Because obviously if Google and Amazon and Microsoft and especially Apple sell off, then obviously the market's going straight down with it fast. Okay, and that's what everybody's kind of waiting to see. But the other thing nobody's talking about is, when's the last time you heard about IPOs? Like big time IPOs coming out. They were coming out a dime a dozen in 2020 and 2021, right? Now, what do you hear? Nothing. I heard the birds chirping. There's no crickets because it's not nighttime. But yeah, that's what's happening. So, I found one of the guys who's, I guess he's voted like by Forbes magazine as one of the best venture capitalists in the world at this. And he's been in IPOs. You've probably been in yourself over the last couple of years and seems to know what he's talking about. But he makes great points that I think investors need to know.
Rick Heitzman, he was an early investor in DraftKings, Pinterest, Airbnb, and he was just named to the Forbes Midas list of the best venture investors in the world for the third straight year. He's founder of First Mark Capital. So I couldn't think of a better time to have somebody who makes their living investing in tech and not just, early or late stage, but public markets too. What do you make of the environment right now?
It's really tough. It's really tough. It's tough in the public markets. In the private markets, it's getting even tougher. So usually there's a lag in the public markets as people don't react to the pain right away. But we're starting to see the news that started to come out last November, continued to the first quarter, is now seeping into the private markets, and people are getting very bearish, especially as the IPO market shut and people don't know when the liquidity is going to come.
I'm betting that the private market valuation reset lags what happens in the public market. Now, you correct me if I'm wrong on that, but if I am right, how much more do valuations need to reset in general?
So it does. The private markets lag the public markets by a quarter or two, as the information has to get through the system. So that reset has to happen. Then there's going to be another reset where people are trying to figure out what happens in the IPO market. This is the third biggest IPO drought of the last 20 years after the original tech downturn in the early aughts and then the great financial crisis. So without a healthy IPO market, you're seeing a discount based not only on the multiples, but liquidity factors, as no one knows when you're going to be able to get to a real public financing market and therefore liquidity for the private market investors.
What's your sense on how much more valuations, let's say public valuations? I mentioned in the intro here that you were early in DraftKings and Pinterest and Airbnb. Unprofitable tech seems to be thrown out by the market. Investors don't want that at all. How long does that continue?
I think it's going to continue for a while. Even as we look at the IPO pipeline coming, we have a number of companies in the 22 IPO pipeline and getting feedback both from bankers as well as buy-side firms. People are very focused on capital efficiency, very focused on unit economics, very focused on path to profitability. And without that path to profitability, people aren't getting public. So the discount's even greater for companies who are losing money. So if you think about delivery companies with bad unit economics or anyone else that hasn't been able to turn the corner on profitability, not only are they getting hurt badly in the public markets, but that pain is being felt even more so in the private market. So I think as you see the next round of IPOs coming, those are going to tend to be profitable companies who have great unit economics and have a path to profitability in the near term.
Even so, I mean, the markets are likely to remain so rocky that I can't imagine a runway to go public that's any shorter. If anything, it's just going to be elongated and continue to go further as long as the markets are as rocky as they are, as the Fed is doing what it does and rates go where they go.
I think you're exactly right. Rates going up at all obviously provides another avenue for people to put their capital. The cost of capital and the risk-free rates going up, and all of last year's IPOs are currently on sale. So there's plenty of inventory out there, and very different from a year ago when everybody was looking for access to IPOs. People are now leaning out of it. So now we're coming into the time of year where you should be able to see an IPO calendar of things that are going to come in the rest of the second quarter before the summer holidays. And that calendar is very weak. So you might not see a return to a healthy private market at the earliest until post-Labor Day in the beginning of Q4.
And, look, everything he says makes sense, right? I mean, look at like DraftKings, for example. There's a chance that stock's going to hit 10. And if it goes under 10, see you later. You know, there's no support there. It was at 1385, I believe it was Friday. Look at PayPal. Look at all these others. Look at Airbnb. And so one good thing is the IPOs that does come forward eventually, they're going to be profitable. Good business models, right? More safer investments. And you'll be able to get them at a better price most likely, right? But as far as the risky stuff, people just not wanting that right now. And so that's interesting to see. The other thing is, looking at this sell-off last week, I didn't feel any panic. Like, this didn't seem like panic selling to me. I think the panic selling already happened, right? And the reason why I think that is because normally when you see, you know, big drops like that, you see a lot of fear in the markets. And no matter which fear ingredient index you look at, you know, we're barely in the fear mode right now, right? At 40. You can see this is when we actually hit bottom March 14th before we get that big run up. It's 16, right? And then you'll get another fear ingredient index I like to follow, right? 35% of stocks are in an uptrend, which is not good. But when you look at when we actually bottomed on March 14th, and I'm saying that is the bottom, but you know, it's around 20 for crying out loud. And with most like real bottoms, you see extreme fear, you know. So was March 14th the real bottom? I don't know. I don't think anybody does know. But you know, the other day I was looking at the bloodbath going on, and it was like, yeah, but there's not extreme fear out there. That's what's kind of weird about it. And if you look back at every other like real sell-off, whether it's back in 2018, I think 14 had one, 20 had one, you know, 08, whatever it was, you have extreme fear before you get this huge move up. And so I don't know, it's gonna be interesting to see what happens this week. If the big cap tech stocks just kill earnings, give great guidance, or whatever the people want to hear, then obviously the indexes are going to stabilize and move up because they're just so heavily weighted. But if the indexes want, like this gentleman just was saying, or one of the gentlemen was saying, you know, that valuations, everything, and they want to try to bring those valuations down on the big tech companies as well, then guess what? That's what's going to happen. And so we're kind of at the mercy, and everybody's kind of waiting to see on pins and needles this week, because to me, this is the biggest week of earnings we're going to get out there right now. The rest of them don't even really matter. It's this right here. And so, you know, we'll see what happens. And if they do give that, maybe people start rotating out of a lot of these commodity stocks like you saw happen on Friday, because all the commodities were down, I think, and then start rotating back over into big tech and start pushing them higher, which will move the markets higher as well. So we'll have to see. I mean, a lot of questions in the markets, guys. I don't think anybody has the answers to them, but you know, that to me is important information to know and have and to be set up for this week, okay? And so I hope you have a good one, and I will see you tomorrow.